Bubbles in our financial system. Systemic risk, the multiple bubble landscape, and interconnected amplification risk. The interconnectedness of today's financial system creates risks far exceeding those from isolated bubbles seen in the past. When real estate, stocks, bonds, commodities, and various alternative assets all exhibit potentially elevated valuations simultaneously, the systemic implications multiply beyond simple arithmetic addition. One key mechanism is cross-collateralization, where assets in one category frequently serve as collateral for acquiring assets in other categories. A homeowner using home equity to purchase stocks creates direct linkage between housing and equity markets. Similarly, corporations borrowing against stock portfolios to purchase real estate intertwine these asset classes at the institutional level. A second mechanism operates through institutional balance sheets, where major financial institutions maintain exposure across multiple bubble-prone categories. Investment banks, pension funds, and insurance companies rarely concentrate in single asset classes, meaning their health depends on the overall stability of interconnected markets. The banking system represents a critical vulnerability within this interconnected framework. Despite improved capital requirements following the 2008 crisis, banks maintain significant exposure to all potential bubble categories through lending, securities holdings, and derivatives. When multiple bubbles exist simultaneously, banking system stress can cascade across all asset classes rather than remaining isolated to specific sectors. This creates what researchers call systemic risk amplification, a situation where the failure of one bubble triggers cascading effects across others via institutional linkages, margin calls, and forced liquidations. The result is a transformation from localized corrections to system-wide crises, as seen in 2008 when housing problems rippled through global financial markets. The normalization of bubble conditions. One of the most powerful yet underappreciated aspects of financial bubbles is what psychologists call normalcy bias, which is our tendency to believe that things will continue as they have been. Today's financial environment demonstrates this phenomenon at scale. Despite historically high valuations across multiple asset classes, stretched leverage metrics, and unprecedented monetary expansion, these conditions have persisted long enough to feel normal, creating a powerful psychological anchor that resists contrary evidence. Extended periods of elevated valuations create particularly insidious psychological effects. As extreme conditions persist across years or decades, they cease to feel extreme. Market participants increasingly accept elevated risk-taking as standard operating procedure, gradually abandoning prudential measures that seemed excessive during earlier, calmer periods. Media coverage amplifies this effect through a paradoxical relationship with fear. While shorter-term market concerns generate engagement through fear-selling headlines and clickbait, fundamental challenges to the overall financial architecture receive significantly less attention. This creates a peculiar information landscape where daily volatility receives disproportionate coverage while decade-scale structural vulnerabilities remain underexamined. A correction in the stock market or even in cryptocurrencies might receive substantially more attention than a drawdown in the bond market, as evidenced by the developments in 2022. The result creates what we might call the expertise paradox. The very professionals most qualified to identify systemic bubbles face the strongest institutional incentives against doing so publicly. When bubble conditions have persisted across years and decades, the cost of being early about their eventual resolution can end careers, while the social and financial rewards for participating in consensus thinking remain substantial. Markets consequently climb the wall of worry on short and medium-term concerns while potentially ignoring longer-term structural vulnerabilities. This pattern continues accumulating stress beneath the surface until fundamental constraints can no longer be ignored or papered over through financial engineering. At that point, what appeared sustainable transforms rapidly into obviously unsustainable, often catching most participants entirely off guard despite warning signs that seem obvious in retrospect. This may or may not be accompanied by a so-called black swan event. In either case, chances are the bubble pop was due to occur anyway. Institutional money, different game, different time frame. Institutional players operate within a fundamentally different framework from retail investors. These sophisticated participants, including family offices, sovereign wealth funds, and specialized hedge funds, often maintain public positions aligned with consensus while quietly implementing contrary strategies. Some of the largest institutional players effectively operate with dual portfolios, a public-facing allocation that signals confidence in system continuity, and a secondary allocation designed for system transformation scenarios. This bifurcated approach allows participation in current market conditions while building protection against the very structural risks that mainstream discourse minimizes. These institutions also benefit from extended time horizons and superior access to information, allowing them to position for eventual bubble resolution without suffering the career risk that shorter-term oriented professionals face. They can afford to be wrong for years if they're eventually right, while public fund managers face quarterly performance pressure that penalizes early recognition of bubble dynamics. The cumulative effect creates a landscape where those with the greatest resources and information access increasingly position themselves for discontinuity while the broader public remains anchored to continuity narratives. This creates a feedback loop where bubble conditions can persist even as the most sophisticated money gradually prepares for their resolution. The fourth turning perspective. The concept of generational cycles provides another framework for understanding our current bubble environment. According to Neil Howe and William Strauss's fourth turning theory, societies move through predictable cycles approximately 80 to 100 years in length, with each cycle containing 4 distinct phases or turnings. The fourth and final turning represents a crisis period where institutional trust deteriorates and social structures undergo significant transformation. If we accept this framework, our current positioning within such a turning helps explain both the multiple bubble phenomenon and the psychological complacency surrounding it. This generational perspective suggests that each major bubble cycle coincides with specific sociological conditions. The current fourth turning environment features both extreme financial risk-taking and growing institutional distrust, seemingly contradictory conditions that actually reinforce each other. The erosion of trust in traditional institutions drives capital toward speculative alternatives, while excessive speculation further undermines institutional credibility when inevitable corrections occur. More importantly, this framework suggests that the persistence of multiple bubbles is a symptom, not a cause, of broader systemic fragility. The financial bubbles exist within a larger context of institutional weakness and societal transition, making their eventual resolution more consequential than typical market cycles. Historical analysis reveals that fourth turning periods often feature similar patterns: initial economic disruption, followed by social upheaval, then institutional reorganization, and finally renewal. Understanding this broader context helps explain why current bubble conditions might feel different from previous cycles. They're unfolding during a generational transition period that amplifies their significance beyond pure financial implications. The no-bubble argument. A thoughtful counter-argument suggests that what appears as bubble behavior actually represents rational price discovery within a new technological and monetary paradigm. This perspective argues that unprecedented monetary expansion since 2008 fundamentally changed asset valuation frameworks, making historical comparisons less relevant. Under this view, elevated asset prices reflect the reality of financial repression and negative real interest rates rather than irrational exuberance. When the risk-free rate remains artificially suppressed for extended periods, all other assets must be repriced higher to maintain appropriate risk premiums. This repricing appears as bubble behavior but actually represents rational investor adaptation to policy-driven monetary conditions. Technological innovation provides additional support for this counter-narrative. If emerging technologies such as blockchain and AI genuinely transform productivity on par with previous industrial revolutions, current valuations might reasonably incorporate future gains. From this perspective, seemingly extended valuations simply reflect forward-looking incorporation of technological transformation rather than speculative excess. Demographic factors provide another pillar for the no-bubble argument. Aging populations in developed economies drive demand for income-producing assets such as bonds and dividend stocks, potentially justifying lower yields and higher valuations across multiple asset classes. Meanwhile, emerging market wealth creation introduces new capital into global financial systems, creating structural support for asset prices across categories. The balanced perspective. The truth likely exists somewhere between pure bubble dynamics and entirely rational repricing. Technological advancement and demographic shifts create genuine forces supporting higher asset valuations. However, these fundamental changes don't negate all historical lessons about market cycles, speculation, and the eventual constraints of mathematics and physics on financial systems. What may be occurring is a more nuanced dynamic where technological progress and demographic trends extend typical bubble durations and alter their characteristics while not eliminating bubble dynamics entirely. This creates a challenging environment where traditional bubble signals appear, while fundamental factors support continued elevation, making navigation particularly difficult for all market participants. Practical implementation and conclusion. Navigating multiple bubble environments requires both technical and psychological preparation. The technical component involves proper allocation, risk management, diversification, and scenario planning. The psychological aspect, often more challenging, requires maintaining disciplined execution when others exhibit either excessive fear or unsustainable optimism. Consider implementing a barbell strategy that pairs defensive core positions with limited opportunistic allocations. This approach acknowledges both bubble risks and the possibility that current conditions could persist longer than expected. The defensive core should emphasize assets with minimal counterparty risk and limited correlation to financial markets, while opportunistic allocations maintain market participation with strict risk parameters. Establish predetermined action triggers based on objective metrics rather than sentiment or timing predictions. These might include specific valuation thresholds, changes to monetary policy regimes, or alterations in your fundamental investment thesis that would prompt portfolio adjustments independent of prevailing market narratives. Remember that bubbles create opportunities alongside risks. Major market dislocations historically provide extraordinary entry points for prepared investors with available capital and the emotional stability to deploy it against prevailing sentiment. Building this preparation during bubble formation creates potential for significant outperformance during subsequent recovery phases. Finally, maintain perspective on your role and limitations as an individual investor. While understanding bubble dynamics provides valuable context for decision-making, successfully timing their resolution remains extraordinarily difficult even for sophisticated professionals. Focus on building resilient portfolios that perform adequately across multiple scenarios rather than trying to perfectly optimize for specific bubble resolution timings. Also, be careful not to mistake short or medium-term bubbles for the longer structural cycle. Localized excess or temporary corrections don't necessarily invalidate broader macro trends or vice versa. A sound strategy should account for both layers without conflating them. The multiple bubble environment represents a unique challenge in financial history, where traditional risk management approaches face unprecedented complexity. Success requires combining historical wisdom with adaptation to genuinely novel conditions, maintaining both humility about prediction capability and confidence in principled preparation strategies.